We could see gold go up to 3,000 in the next few years and the Dow drop to 3,000. That doesn't seem very likely, but it's possible. Or we could have gold go up to 8 or 10,000 and the Dow drop to 8 or 10,000. Or these people might inflate things even more. They might bring in a war, just like Roosevelt kind of pushed the US into a war. And we could see, gold at 40,000 and the Dow staying pretty much where it is.
In recent years, gold has solidified its reputation as a reliable store of wealth, particularly during periods of economic and political instability. Over the past 5 years, the weekly spot price of gold has surged by more than 70%. This growth underscores the asset's increasing appeal among investors seeking stability amidst market volatility. The performance of gold is often compared to that of the Dow Jones Industrial Average, a standard benchmark for gold investors. Notably, the Dow-to-gold ratio has stabilized recently, following a sharp decline early in the COVID-19 pandemic. This decline in the ratio coincided with a spike in gold prices and a drop in stock market performance, highlighting gold's role as a safe haven in times of economic distress. MarioInnecco, a respected financial analyst and commentator, has long emphasized the significance of gold in preserving wealth. Innecco predicts that gold will continue to outperform in the coming years, potentially leading to a convergence between the Dow and gold prices. He suggests that we could see a 1-to-1 ratio, where gold might rise to $3,000 or more, while the Dow could either fall or both could climb significantly higher due to inflationary pressures. The recent surge in gold prices is not an isolated event, but rather part of a broader historical trend. Gold has consistently increased in value during times of uncertainty, such as in the years following the U.S. abandonment of the gold standard in the early 1970s and throughout the stagflation of the late 1970s and early 1980s. Innecco notes that the Dow-to-gold ratio, which had previously bottomed due to central bank interventions, is now downward. This pattern suggests that gold may continue to rise as investors seek refuge from the economic and geopolitical uncertainties of the current era. Please tune in for our exploration of MarioInnecco's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
The first important one, I think, in the 30s was that they allowed the Fed to start buying government bonds. And the second one was the Humphrey-Hawkins Act of 1978, which said that the Fed had to promote stable prices and balanced growth, Flu Employment and Balanced Growth Act. And this has given the Fed the excuse to intervene. And not just the Fed, but other world central banks. If you remember well, here in 2011, where we had this kind of, I would say this was like a kicking the can down the road bottom for the credit cycle correction. You had the ECB and Mario Draghi saying we're going to do whatever it takes to keep the euro alive. That meant more money printing. 2013, we had the Japanese and Abenomics do the same thing. So I think this bottom in the Dow-gold ratio was due to the fact that the major central bankers of the world kicked the can a little longer. And then we rose back to 22, but we never went back to that 42, 40 level. And now, as you can see, we're turning. And since the end of last year, beginning of this year, we've broken below this trend line. And that's why I think we are on our last leg here, and it's confirmed. So how is it going to play out? It could be a mixture, I would say, of what happened in the 30s and what happened in the late 60s to 1980. So a mixture of a lot of bankruptcies, defaults, but also a lot of money printing and stagflation. That's how I see it. What price are the two instruments you're going to match? Well, it's difficult to say, but one thing I would say, though, that you need to have is gold, because gold is going to outperform. And I think we're going to get to 1-to-1 or very close, and even If we're down to like 2 to 1, it might sound a bargain, but if we drop to 1 to 1, it's a huge move. And who knows, we might even go below 1, which means, let's say, you might be able to buy a whole Dow Jones Industrial Average index for half an ounce of gold. So whatever happens, you need to think of it in relative terms. We could see gold go up to 3,000 in the next few years, and the Dow drop to 3,000. That doesn't seem very likely, but it's possible. Or we could have gold go up to 8 or 10,000 and the Dow drop to 8 or 10,000. Or these people might inflate things even more. They might bring in a war, just like Roosevelt kind of pushed the U.S. into a war. And we could see, gold at 40,000 and the Dow staying pretty much where it is. So a little bit like in the 70s, where the Dow, I think from the late 60s to 1980, the Dow was like sideways, but the currency, of course, lost massively.
MarioInnecco, a renowned financial analyst, emphasizes that gold remains the ultimate measure of value and wealth, particularly during market turmoil. He points to significant economic events, such as the dot-com bubble bursting in 2000 and 2001, and the financial crisis of 2007 and 2008, as pivotal moments when gold demonstrated its strength. During these periods, the Dow-to-gold ratio declined sharply, nearly reaching 6.5 by 2011, underscoring the ongoing correction in the massive credit bubble that began in 1980. Gold's behavior during market crashes is particularly noteworthy. On Black Monday in 1987, while the New York Stock Exchange's Dow Jones Index plummeted by more than 20% in a single session, gold prices jumped 3.2%. This divergence highlights gold's resilience during extreme market shocks. However, a substantial gain during a stock market crash is relatively unique. Let's get back to the interview.
By the time we got to 1980, but gold multiplied from $35 an ounce to a high of 887. Some people talk about 850, but the intraday high was 887. So in terms of the Dow, in terms of gold, the Dow dropped like 94%. And that was the bottom there in 1980. The credit boom that we had since the Depression that had topped in the 60s. And it was the right time to get back into stocks and bonds. By 1999, as you can see here, we got up to above 40. So every time these credit bubbles are getting bigger and bigger. And why do I think that happened? Well, because we had the Federal Reserve, a central bank that was created in 1913, started operating in 1914. So the government could borrow from the Federal Reserve. And where did the Fed get its money? Well, it just created it out of thin air. Even in the 30s, before even FDR took over, the U.S. government was borrowing like $2 billion to $4 billion from the Fed. They had to change the law, of course, because the Fed, when it was created, it was only supposed to own discounted bills, not long-term government bonds. So they keep changing the rules, of course. And I highly recommend this book here, The Great Depression, a diary of Benjamin Roth. I'm reading it right now. It's an amazing book. You need to read it. So what's happened since 99, 2000? You might think, we haven't had a correction yet in the credit bubble. The credit bubble is growing even more. And to an extent, it is in terms of fiat dollars. I just saw the other day that world debt has gone up to $315 trillion. But the key here is to get back to gold, because gold is the ultimate measure of value. As Jim Sinclair also said once, it's the true revealer of wealth. So what's been happening since 2000 and the correction of this massive credit bubble that we've had since 1980? Well, we know what happened in 2000. 2001, the dot-com bubble burst. Stock markets corrected big time. And yes, the credit cycle started turning in terms of gold. And it accelerated in 07, 08. And by 2011, we were on our way down. Of course, as you can see here, we got down to almost 6.5, the Dow-gold ratio.
Gold has consistently proven its worth as a reliable store of value during financial instability. From the sharp market corrections of the early 2000s to the shocks of the global financial crisis, gold has stood out as a resilient asset, capable of preserving wealth even when other investments falter. Its ability to hold its value and recover quickly during market crashes underscores its importance in a diversified portfolio. As economic uncertainties continue to loom, gold's role as a hedge against volatility and a measure of true wealth remains as relevant as ever. How prepared are we to safeguard our wealth against the next market downturn? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.